Indeed, you can take the cow to the river, but you cannot force it to drink water. These are not my words, but words of KRA. KRA wonders, how come people continue to complain that taxes are high in Kenya, but when we give them tax exemption, tax reliefs, and tax credits, they don't want to take advantage of that? In my previous video, I discussed about personal tax relief, insurance relief, and mortgage interest relief. Today, I want to discuss about disability tax relief, pension and provident funds tax relief for the contributions that we make to those pension funds, and also the withholding tax credits. To start us off, let me address about the disability tax relief. Do you know that in Kenya, if you are a person with disability, you are supposed to have a tax-free income up to a tune of 150,000 Kenya shillings per month? Did you know that? You know, a normal person who is not living with special conditions, they start paying income tax via pay as you earn as soon as their income hits 24,000 per month. But if you're a person living with disability and you are registered with the National Council of Persons with Disability and also with the Ministry of Health, you are required to obtain a tax exemption card from KRA so that you can give the same to your accountant. And once you give the same to your accountant, then voila, all of a sudden your pay as you earn taxes reduces significantly. If you're earning anything less than 150,000 per month, that means you don't even pay a single cent. Remember, your accountant has no power to do this unless you empower them with a tax exemption certificate from KRA. And we know it does expire, so it has to be renewed. And it is not the accountant to say that your disability is not disability enough. No. As long as you provide them with a tax exemption card certificate, then you are good to go. It's the same thing. People with disability, they qualify for certain tax exempted imports. If it is a car that is customized for a person with disability, living with disability, the same thing when it comes to custom taxes, they import free of charge. Now, number two, let me discuss about the contributions that you make to either a pension fund or a provident fund. Provident funds. And what is the difference between these two? When you make monthly contributions to a pension fund, what that means is that you're planning for your retirement age. That once you retire, you will be guaranteed to be getting a consistent amount of money on a monthly basis. So when you are still within your active age, you ensure that you save and plan for your retirement. So under pension fund, you don't get amount in lump sum, but it's some sort of annuity that you get payment on a month-to-month basis, just like when you are in full employment. But for provident fund, when you invest in provident fund, once you attain the age of retirement, you qualify to get the lump sum amount of money that you had saved there. And so every contribution you make to such a firm or for such a purpose, up to a maximum of 30,000 per month, it is tax deductible. So if you earn 100,000, but you are good enough, you are forward-looking, you are visionary, you save 30,000 per month towards a pension fund or a provident fund, what that means is that your salary gets deducted that 30,000 and you only start paying for pay as you earn for the 70,000 amount, not the 100,000. The good thing with this is that even NSSF is part of the pension fund. And that's why your contributions to NSSF, they are tax deductible. That before your employer computes how much pay as you earn you should pay per month, they first deduct how much you are paying for NSSF, and then they compute pay as you earn thereafter. The other item that it's very important to discuss is if you are a professional. You could be a lawyer, you could be an accountant, a valuer, a quantity surveyor, engineer, name it. And that some of your clients do pay you after they have deducted withholding taxes. For professional income, any person who is interacting with a professional and they are required to pay them some amount of money for the service provided to them by this particular professional, as long as this amount is above 24,000, they are supposed to deduct a withholding tax of 5%. Now, what you are supposed to understand as a professional, if there are some people who withheld 5% of what they should have paid you, first ensure that they pay that amount to KRA. Because there are people who can withhold, they are supposed to pay you 100,000, they pay you 95,000, and then this 5,000, they promise that they would remit it to KRA. Remember, when they pay you 95,000 and not 100,000, it is not a discount that you are giving to them, that they are justified to pay you 95. Even that other 5,000 is your money that you should claim at the end of the day from KRA. So always ensure whenever someone pays you less, ensure that they file that tax returns to KRA. How do you know that? Is because KRA will also notify you as a taxpayer that 5,000, which is 5% of 100,000, has been paid to us as KRA by one of your clients. So when you'll be filing your final taxes at the end of the year, remember to also offset your tax liability with this amount of money. How do you know that your client who withheld 5% of your money has paid and remitted to KRA? It is very simple, that you have an email address that is linked to your KRA PIN. You always need to check that email address. And for that purpose, also, you also need to ensure that your KRA PIN is connected to the mobile line, the telephone line that you use on a day-to-day basis, so that in case KRA wants to reach out to you, they can succeed in doing so. So now, once the client who has withheld 5% of your money files and pays the same to KRA, KRA notifies you. And you can download that certificate, that email notification, and save it so that you don't forget when it comes to filing your final taxes at the end of the year. So now that you understand about those three tax exemptions, reliefs, and discounts, credits that I've mentioned, ensure that you take advantage of them. I've unpacked about the withholding tax credits that you need to take advantage of. We have also discussed about pension and provident funds contributions that you make, and also the aspect of disability relief. If you are a person living with disability, the government cares for you, and that's why they have reduced the amount of taxes payable by you so that you can take care of the additional tax expenses or living expenses that you incur in terms of medication, buying equipment. And so if you don't take advantage of that, who is to blame? If you don't take advantage of mortgage interest relief, what I discussed the other day, or if you don't take advantage of personal tax relief, if you don't take advantage of insurance tax relief and the credit and the withholding tax credits, who is to blame? Remember, you can take a cow to the river, but you can't force it to drink water. When you know better, you should do better.